Hello guys, welcome to today's edition again. Um, Today I'm not really going to shout because I'm having serious headache, like a very serious headache. So I do not want to shout. I'm just going to do everything very calmly, and it's going to be a quick class. It's basically something we know very very well. So I'm just going to do a rundown of it again to make sure that we understand what market structure is. So, like I said yesterday, I'll continue from market structure. I actually wanted to complete yesterday's class, but I don't really think there's anything I still need to say. If there is, maybe I will just say it after this marathon class. But for now, let me just continue from where I stopped. So, today's class is all about market structure. So, what is market structure? You should understand something that in trading, the structure is key. The structure is like the framework of the market, and then the liquidity is what moves it or what gives it direction. If you understand market structure and understand where liquidity is, you have 70% of what you need to be a successful trader. You actually do 70%. I didn't say 10, 20, I said 70. If you understand market structure, understand where your highs and your lows are, and then understands where liquidities are. Like that's why I started this class with liquidity. If you understand all of them, then you definitely have what it takes to be a successful trader. Please hold on. All right, sorry guys, I had a call on my phone, so I had to check it. So market structure is like a map that we study to know where we are in the market, to know if we are either on continuation or pullback, maybe correction, because if price moves to the upside, it needs to correct that movement. And then if it moves again, it needs to correct the movement. So basically, there are three forms of market structure, like we all know. Just three. It's three. It's either it's an uptrend or it's a downtrend. It's a downtrend or it's a ranging market, or we call consolidation. In this class, we wouldn't be talking about ranging markets because I really don't have anything to do with it. And I don't think any sensible human being trades the ranging market. Sorry. I don't really think any sensible human being trades the ranging markets. So what happens here is when market is making series of higher highs and higher lows, we call it an uptrend. When it's making series of lower highs and lower lows, it's a downtrend. You all know about this. These are just basic stuffs in markets. But then this is just the skeletal representation of what price is. But we all know that price doesn't move like this. It naturally doesn't move like this. In fact, I will delete this. The uptrend looks more something like this. It will look something like this. It will look something like this. This is more of a representation of the forex market than what we represented before. So the big question here is, what is the main structure and what is the internal structure? To be fair, is okay, let's just take this up. If we look at this market structure right here, every single one of you can agree that this is a downtrend. If you don't know what downtrend is, it means that the market is making series of lower highs and lower lows, lower high, lower low, lower high, lower low, lower highs, lower low. And there are basically many market structures inside this movement. You don't even know which one is which. You don't know which one to pick. You don't know which one is your low. You don't know which one is your high. That is the purpose of this class. After this class, I don't think any one of you will still find it difficult to understand where your lower highs and your lower low is. So the first thing to do is to actually identify the movement. Identify this is a downtrend. This is a downtrend. Why? Because market is making series of lower highs and lower lows. Price is moving down. This is Euro USD on the daily time frame. I basically choose this particular place to teach you because there are lots of external and internal liquidities inside it. So I want to teach you on how you can actually spot out your ranges from this point. So if you are in a market and it is giving you something like this, you should know something. When we are picking a trend, there are two things that qualifies a trend. The first is the premium and the discount areas, and the second is manipulation. Every single low in the market is a valid low. Every single high is a valid high. Also, every single low in the market is liquidity. So is every single high. There is no two ways about it. Absolutely no two ways about it. So instead, what we have now is strong highs and strong lows. Like if you look at this market structure right here, you will agree with me that this is a strong high, sorry, strong low, strong high, strong low, strong high, strong low, strong high, strong low, strong high. Sorry, I'm going to delete this. Strong low, strong high, and then finally, so you mark out your break of market structures. Of course, it's not the internal break of structures, it's actually the external. So I'm going to explain the internal and the external right now so you understand something. Then I will also teach you how to avoid the internal because I don't think anybody trades the internal market structure. So in this video, I will basically be teaching in this particular class, I'll be teaching trend just like we know it. And then we have strong lows, strong lows and highs, highs. Then maybe failed swing, failed swing, and what else? Um, any other thing? Premium and discount, we know about that. Everyone here knows about premium and discount. Is there anything else that I should add to it? I don't really think there is. I think this is basically it. In fact, the purpose of this class is just about the strong lows and strong highs, and then the failed swings. Those are the important factors you need to note when you are taking your trade. I'm sorry, guys, I'm really having a call right now, and I really need to take the call. I'm sorry, I'll pause it. I'm very sorry, guys. I I had to take that call. It was important. But now I'm back. So I'm really, really sorry. So what we should understand is we'll be talking about trends, and then we'll also be talking about strong lows and highs, failed swings, of course, you know about premium and discounts, and then any other thing. I don't think so. Okay, I guess that should be it. If I remember any other thing, I might add it to what we are doing. So, in this case, if you look at this, you definitely see um, a downtrend. Of course, it's very, very obvious that this is a downtrend. Very, very obvious. You can see it clearly. It's a downtrend. But then, on the other hand, look at this. So, say an uptrend. Of course, price is making series of higher highs and higher lows. But then what makes this particular price movement different from this one? You just have to tell yourself that it's not really that easy. Like structure is not really that simple. But what you might see as structure might not actually be structure. And then what you are seeing as it's not a structure might actually not be a structure. Because if you look at this, price is actually making higher highs and higher lows. Because we have this higher high. I think we actually have this high, low, high, and then this low, because this low haven't taken out this one. So we have this high, we have this low, we have this high, and then this low, and then sorry, and this high, this low, this high, this low, this high, low, low, high, low, high. If you see a structure like this, what does it entails? Like what does it basically tell you? Of course, it's very, very choppy, but it's still making series of higher highs and higher lows. And at the same time, it has broken previous structure at the same time. So what does this tell you? To me, in my understanding of the market, this eventually means that price haven't grabbed enough liquidity. So one thing you should understand about price is that if there is no liquidity, it will build liquidity. Why? I think someone once asked me that question. So why does price need to build liquidity when there is no liquidity? It's very, very simple. It's building its future targets. That's basically it. If you say a market like this, it's an uptrend, it's making series of higher highs and higher lows, but then it's not really clear, it's just liquidity build. This eventually means that price is creating everything here for its future targets. You might zoom this out and then start looking for maybe the next possible zone price could react from. Could be this reacted of this breaker and then from this demand, and then price could just come into this demand just like as it is, and then take out everything it has built here. It's just that very simple. It could just come back and take all of them out because price was building liquidity, and like I said before, it's building its future targets. Of course, I can't really remember what happened here, but I think it did take it out. Yes, something like that. Something like that. So that brings us to the case of how do we even know a market structure that is valid and one that is not valid. Just like this was an uptrend, like I said, and then price built up liquidity and took it out. So before you actually understand that what a trend is, you have to understand that before a trend starts, price has to grab liquidity from either the upside or the downside and then starts a trend. And then the strength of that trend depends on how much liquidity price grabs. For example, if we have maybe let's say a previous year low right here, and then price comes in. Maybe it's been like this for a very long time. Price comes in, induce it, and then grabs it. What you should expect is that when price comes back, it will come back with so much impulse. Sometimes it might not even return to the discount, and then it will continue. But then every single structure it will create from this point upward have to respect the structure. Now, this is how you know a valid, like a strong trend when it starts. Once the grab of liquidity is done, price moves impulsively. It has to protect this low. That is why it moves with that impulse. So I guess you know what I'm talking about. Like if you go back to your charts and then check it out, because I'm not really sure I'll be showing that right now on charts. I'll just give you the schematic. Go and check it out yourself. That's why you are in the mentorship. That's why I'm teaching you. I don't have to show you everything. But then once price grabs liquidity, an important liquidity, remember, a very, very important one, like previous year's high or low, or maybe 5 years high or low, and then it rallies to the upside with impulse, there's every likelihood that it might not return to the premium and discount. So the two cases that qualifies um what is it called? A trend. Like I said before, what qualifies a trend is basically very simple. Very, very simple. First, there are three rules. Number one rule is that it has to break structure. The second one is that the high or the low it forms after breaking structure have to return to the discount. So we'll go back to this point and then we drag price down. So what do you see when you see this? This was the last low and this was the high it made. So when price breaks a high or a low, the returning price have to come into discount. Remember, this one also came into the discount area, but then was it really a valid low for us? No, it wasn't. We had to wait for deeper retracement into the discount. It doesn't really matter if the first one retraced deeply into the discount or it didn't, but then the case three is actually supposed to guide you first. The first rule is that it has to break structure. The second rule is that it has to retrace into the discount or premium. Discounts for uptrend, premium for downtrend. If you don't know what it means, or maybe in the daily charts, maybe price cycle, like I was saying yesterday, that in price cycle in a day, the opening price signifies equilibrium. When price is above it is premium, when it's below it is discount, and you know what to do. It's the same thing here. When once price breaks structure to the upside and then retraces into the premium, this becomes our valid low. This is also a low, but this is our valid low. And then what next? It breaks structure again to the upside. We need to wait for it to retrace into the discount or the premium, just like this. The same thing happens. If you have a low, okay, if you have a low and a high, and then the low produced a break of structure of the high to form a higher high, and then the low doesn't retrace into the discount area, that low it's just liquidity. That particular low is just liquidity. There are no two ways about it. If this low right here, just like this one, didn't come back into this premium zone, it is just liquidity. There are no two ways about it. So the rules are: first, price needs to break structure, BOS, sorry, BOS. Then second, it needs to come back into premium or discount. Premium or discount. So if we come into this trend right now, I'll put it on auto to see everything clearly. If we come into this trend right now, what do we see? Let's just take this one that starts from the downtrend. If we come into this trend, what do we see right now? First, we see a break of structure. In fact, let me mark out the highs and lows that I think are valid, and then we check them out with premium and discount. This is a high, then a low, and then a higher high, and then a higher low, higher high, then higher low, like this, higher low, and then higher high, and then higher low, higher high, and then higher low, and then higher high, low, sorry, low, higher low, lower low, higher low, lower low. So you mark out your break of structures, of course. Price needs to break structures to the downside. So rules number one met. Price needs to break structure to the downside for all of them. Rules number one. Of course, we are in a downtrend, so we should be looking for break of structures to the downside. Unless price now breaks structure to the upside, then we consider that a shift. Now you see how neat this looks. But then remember, this wasn't actually as neat as this because we had internal structures. Of course, we had internal structures that confused us about our market structures. So, and I'm going to show you why I was able to pick out the right ones, not just because it was like this, even if price was just playing out. So, this becomes our break of structures to the downside. And then there's something we call a range. This is a range from this from this 1.0% level to this 0.0% level is our trading range. If price made a move from here, just like price have made a move from here to here, from this low to this high becomes our trading range. Everything we are doing depends on this range until one of them is taken out. So we do not count this as a market structure shift. This is a fake break of market structure. So we can only call a market structure shift if either this low is taken out because we are in an uptrend. So this low needs to be taken out because it was the last valid low. It needs to be taken out for us to call this a market structure shift. But then if this low is protected, we should now be looking for these highs to be taken out to call this a continuation in trend. And that is exactly what is happening. So now how was I able to pick my strong highs and my strong lows? Sorry, my highs and my lows. If I insert my Fibonacci from my high to my low, you see how where each low is coming in is coming out from above the 50% level. Every single one of them have to come out from the 50% level. If it doesn't, it is not valid. That is rule number two. They have to come out from premium or discount depending on the trend. Premium for downtrend, discount for uptrend. In this case, we are in a downtrend, so they should be coming out from premium, and every single one of them is coming out from premium, just like all of everyone can see right here. Every single one of them is coming out from premium. So now comes the big question: which ones are internal highs and internal lows? Once you've identified your highs and your lows, every single thing in between that range is now internal. Every single movement, just like from here to this point, is our highest high and our lowest low. So we call this our higher low and this our lower low. All these market structures inside this range is our internal structures. And then this high and this low is our external structures. We use these ones for entry or to seek market structure shifts for entries, and then these ones as our targets. It's that simple. So that brings us to the next concept, which is what? The strong highs and the strong lows. How do we know a strong high and a strong low? It is very, very simple. This is the most important thing in market structure that we haven't talked about before. And I'm telling you now what it is. We come back here. We've identified a trend. Of course, trend follows the same thing in all time frames, both 4 hours, 3 hours, 2 hours, 30 minutes, 15 minutes. It's basically the same thing. What we are just teaching is trend. We are not teaching their correlation from one daily to 4 hours to 1 hour just for us to do top down analysis. When we get to top down analysis, we do that one. But then, how do we now identify a strong high and a strong low? This is the rule. A strong high, a strong high or low is a high or low that costs manipulation and produced a break of structure. For you to call your low a low or your high a high, that particular high needs to first manipulate price. What I mean by manipulate means it needs to grab liquidity. It needs to grab liquidity because that liquidity is what moves the market. Price needs to grab liquidity first. That is what qualifies a low or a high to be a low. So that is why when I told you that eventually this is how the market moves and not the other or the normal pattern of higher high, higher low, higher high, higher low, everyone draws. So what happens? You can agree with me that every single low right here in this market structure grabbed liquidity before moving to the upside. Now notice something or understand something I said before. If there is no liquidity, price will create liquidity on its own. Of course, it needs to induce some traders into the wrong direction and then clear them out for them to actually move to the opposite direction when we get to picking zones and knowing if your zone will actually play out or not. I'll tell you how. For now, let's just continue with what we are doing. So every single low or high before they produce that break of structure to the upside have to manipulate price. It doesn't these ones are the ones they created. Price didn't see a liquidity to grab, so it created one by itself. If there was a low right here for it to grab, maybe something like this one, price will then grab it. Sorry, price will then grab this low first before it continues to the upside. So that is how you know if your high is strong or not. We call them strong highs. Like you see most traders actually putting something like this on them, a curve, and then label it strong high, sorry, strong low, and then you see this one, strong low, you see this one, strong low. Why? Because all of them cost manipulation before they broke structure to the upside. You have this one again, strong low. You have another one, strong low. Then these other highs right here are now weak highs or weak low because note this, for every strong low there is a weak high, and for every strong high there is a weak low. As long as this low failed, or let's start from it. As long as this high right here failed to break this low, it is a weak high. And as long as this one produced a break of structure of this one, it is strong. This trend will continue until we get a weak high, sorry, a strong high. That means a high that will eventually take out this low. And that is where the idea of failed swing comes into play. What does that mean? It just means that price have now failed to produce a higher high in the case of an uptrend, or a lower low in the case of a downtrend. So you should now be looking for market structure shifts or entries in around this zone to take price lower. So let's go back to where we were and see all these lows or all these highs we picked. Did all of them, did they all produce break of structure or manipulation before moving to the downside? So I will just start taking this Fibonacci tools out. Sorry guys, I'm really slow. I'm not like your YouTube mentors who are very fast and they click it pap 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 and they are done. I'm not like that. I'm just someone who likes to take time and explain everything as they occur in the market. So first thing first, this was a high and a low, and then we have this liquidity build in the form of equal high. What happened? It was cleared, and then this one cleared out this liquidity. So grab liquidity from this low before this down move. And then what about this ones? The same thing. Grab liquidity, and then this one grab liquidity, and then moved to the downside. For this one, I think the liquidity was not actually very strong for it to grab as price was moving up to the upside. Instead, it created one for itself. Or maybe there wasn't enough buy stops or stop loss around this zone. So price needed to like fake people in. I hope you know this actually looks like a market structure shift right here. But what people have failed to understand is that this wasn't the low we are talking about. The range is from here to here and not from here to here. Although the break of structure came from this low, but overall, this is where this trend started because this was where the last manipulation came. This have actually induced many people into believing that yes, we have a market structure shift. They have now gone long to take price higher, and all of a sudden it hits this demand or supply level in around this zone, and piam, that is just it. And what happens again? Price comes back, grab liquidity, and then break structure to the downside. It will continue making these moves because this was liquidity grab. It will continue making this move until it is tired. That is just the simple rule. Price needs to cause manipulation and then produce a break of structure. Only then will you say, okay, this is a lower low, this is a lower high. It follows the same thing in all time frame. Just very simple. Even I think I had this. This was on the 1 hour. Yes, 1 hour time frame. If we start from this point, you see what happened. Price produced manipulation, takes out liquidity, and then break structure to the upside. Sorry, break structure. I'll use an arrow. Break structure to the upside, and then price comes back here. Now notice something. This also produced. Sorry, this low right here produced a break of structure. But then why was it taken out? That's the big question. This produced a break of structure, of course. Rule number one, it produced a break of structure. Rule number two, it was coming from premium, sorry, from discount. So why was it taken out right here and then price still continue on the trend? Very simple. There was no liquidity grab. This low didn't grab any liquidity. There was no manipulation. So this low itself became liquidity and then price came back to grab it. It's just very simple, guys. Very, very simple. Very, very simple. Price then came back to grab it and then produced the next break of structure. Even these internal lows, internal structures, yeah, the same thing are happening. Of course, these are now internal structures because our range is now from this low to whenever it breaks this high, from this low to this high, and then this low now taps into this one, and then it's the same thing. This actually signified a start of another trend, although to me internal, but it's still doing the same thing. It's still basically the same thing. Manipulation, break of structure, and then mitigation. When price came down right here for the first time, there was no liquidity for it to grab. Instead, it created the liquidity itself in the form of ICT, or ICT student call it turtle soup, one, two, three. And then it grabbed the liquidity before producing the next break of structure. It's just that simple. Just that simple. And what happens? Price comes down, grab liquidity, grabs liquidity in the form of equal low, and then broke structure to the upside. Broke structure, this one, to the upside. What happens again? Price comes down, grabs liquidity, because this was a liquidity grab. Even this down here, this other low, all of them were liquidities. Grabs liquidity and then produce another break of structure. Even the internal structures needs to, they all need to obey the same rules, but you just need to understand your range and everything. And then what happens? Price comes down. Now, remember something. This is where strong trend comes into play. And you can see the impulse. That actually means that price have done every single manipulation it needed. Remember what I said? I said this was internal structure. Everything happening here was just price building liquidity, grabbing it, building liquidity, grabbing it, and all of a sudden it just grabs enough and rallied up. It's just that simple. And then after that, what happens? You don't expect it to come back to the premium immediately. So created another low high, and then what next? Grab liquidity might not actually be enough, and then we now need to see price produce a higher high. If it doesn't, we now start looking for structure shifts. We actually have a structure shift right now. So you can now be looking for entries for sell. It's just that simple. Should be looking for entries for sell now. Someone might be asking, what if this is just to fill this fair value gap? It's possible, but this actually like met all my rules, so there's no need for me not to sell. You just be looking for price to pull back and then getting into a sell position because for the first pullback, breaker block, SND flip, price pulls back into it, then take your shots. It's just like that. It's just like that. Just that. Now, this is the case of a failed swing. I hope you are understanding what I'm telling you. I've moved this price from you identifying breakup structures, premium and discount, and then to strong and weak lows. Identifying your strong and weak lows in market structure is actually the most important thing in reading market structure. Now, there is no way that you've understood what liquidity is. You know where your price is in the price cycle, like I explained yesterday. You've identified your market structure, you've picked out the right lows and the right highs, and then market is pulling back into your discount, grabbing liquidity. There is absolutely no way, unless you suck at trading, there is no way that out of 10 trades, 7 or 6 will not play out. There is no way, absolutely no way. There is no way. I repeat it again, there is no way. If you understand these little concepts that I'm telling you, there is no way that market can take be like smashing your zones for no reason, for no absolute reason. Market actually smashes your zone first if, for instance, you are now entering like of course, this was now a failed swing as price have failed to break this high right here, even though it grabbed this liquidity somewhere here. Of course, this was a manipulation. If you check it on the lower time frame, this was a real manipulation, grabbed liquidity and all those stuff. So as price have grabbed the liquidity here and then failed to break it, and then coming back, of course, most traders will be going long here, and then it induces them into thinking that position is going long and then takes them out. This is the only valid loss I can count and tell you, okay, this one, it's not your fault. But then you missing everything that I've been explaining to you here, or maybe you trying to enter off a trade here, knowing fully well that this low haven't grabbed any liquidity, and then price is coming back. It's liquidity. I once said it, I posted it on my WhatsApp status when I said, if your zone or your POI doesn't haven't grabbed liquidity, then that POI itself is liquidity for another POI either below or above it. It is that way. There is no other explanation for it. If your POI doesn't have liquidity or haven't grabbed liquidity, and then price doesn't induce it, that POI itself is liquidity. Now, every single liquidity price is grabbing here is inducement. That's why when I pick my zones, I think there was one I sent the other day. I told you guys, I'm not really sure about this trade because I think that was on AUD NCD. I told you guys, this setup looks fine, but I'm not sure of it because I'm very, very sure because price did not induce this POI. There is no inducement. And haven't had it that price wrecked it last if the POI was not even there. It was a demand zone, there was fair value gap and all those things, but price just wrecked it through as if the POI was not even existing. It just wrecked it through and then went and mitigated another POI. Now I kept on watching the price. I didn't even enter it because I wasn't sure of it. I kept on watching it. It went and mitigated another POI below that one I wanted to buy from. And then it rallied up. That is just how simple it is. Understanding where you are, where you expect liquidity. Of course, you don't really know where liquidity is because you don't have the data, but you have to understand where the liquidity is or where you expect them to be. Understanding them, understanding your market structure, understanding your price cycle, and then picking out your right highs and lows based on the fact that they have grabbed or manipulated price and then produced a break of structure, you are already 70% ahead of any other trader. 70%. That is just it. So I'm going to say all this and I want you to go in every single trend you see in the market. Just check it out. Before the low formed a new high, did the low manipulate price? If it is no, then ask yourself, what happened after forming the high? Did price come back and take out the low? If it's yes, fine. Then if your first answer to the first question was yes, price manipulated before breaking structure, ask ask yourself the next question. What happened after the break of structure? Was that low protected or not? If everything tallies together, you understand. So that is just it, the trend, understanding it, higher highs, higher lows, and then the strong highs and the strong lows, the strong trend, like I said, if price grabs an important liquidity, it will start a very strong trend, like very, very strong trend. Something like, let's go to, I think I'll just delete everything here. I'll just delete everything. Let's go to monthly, maybe monthly like this. or maybe daily, weekly, sorry. We break them to weekly, something like this, something like this, something like this. Liquidity grab, importance, any other one, liquidity grab, and then a strong trend, liquidity grab, strong trend, liquidity, and all those stuff just keeps on going. Something like this. Just remove this, flatten it. Yes. And then it just keeps going. Maybe. Okay, let's start from this one. Something like this. This was February. February's low. So the month of February low. Price grabs it and then starts a trend. It's month of February, like this one, and then also this one. Of course, we did this one the other day, so I wouldn't be going over it all over again. It's really not that important. And then this one, price grabs and then drops. Like I said, every single time, price needs to grab an important liquidity before it starts a trend. Any single trend at all, it needs to grab important liquidity before it starts any single trend. So when price grabs liquidity, just like it did here, you will agree with me that the first move to the upside didn't return to the premium. This first break of structure, it didn't return because price have grabbed enough liquidity, did every single manipulation it wanted, and then rallied. But from there, every other structure had to be respected. All of them, they had to be respected. That is just how it is. That is just what it is. Just like this one too, and then grabbed and everything. It's just very very simple. So when price is making higher highs, higher lows, higher highs, higher lows, you know what to expect. First, premium and discount. Sorry, first it's a break of structure, premium and discounts. Of course, higher time frame market structure is stronger than the lower time frame market structure. You do not expect if we are in a downtrend, a downtrend, you do not expect a 15 minutes demand zone to take out a 4 hours supply zone. It doesn't happen that way. The 4 hours time frame needs to switch, sorry, need to shift structure first before you start entering to take out the supply zone. Or maybe you are now taking a 1 hour supply zone to take out a daily demand zone. It doesn't happen that way. It doesn't happen that way. So higher time frame structure is still greater than the lower time frame structure, but every single structure remains the same. So that brings us to the idea of failed swing. What is failed swing? Failed swing is when a trend is moving, maybe uptrend or downtrend, and all of a sudden, this the weak, sorry, the last low that produced break of structure now gets shifted. That means gets taken out. It was a strong high or low before, but eventually it now becomes weak because it has been broken. Once that low is taken out, the next thing for you to do is check if there is an inducement towards the supply that produced that break of structure, and if there is, you take your trade. There is absolutely no other way. It's just that simple. No other way. I think I had something like that somewhere here. This was a case of a failed swing. a failed swing. I think this happened, this was 2021. Price have broken structure to the upside, and then it has taken out this low at the same time. So what happens? We look for inducements towards this low. This becomes our inducement. Price was initially making higher highs, series of higher highs and higher lows. Price was making series of higher highs, higher lows, higher highs, higher lows, higher highs, higher highs. This didn't even grab any structure. Price might still just come down, take structure from here or maybe and continue. But for me, this wouldn't really be a valid low. This one was grab structure and then produced this break of structure and then came down. Was it at discounts? No, it didn't retrace into the. Okay, so this is not valid. This is not valid because this low failed to come into what is it called, to the discount price. So we wouldn't actually consider this a valid zone. We might just be taking a shot here to either mitigate or come down deeper into our discount, and then if there is a shift of this low right here now, only then we will consider that price have shifted in structure. So this is actually a very important idea of a failed swing because price have failed to produce um, a new high after breaking the last one. This is an example of a failed swing. So you could be taking your sales from any of these zones. I know most of you always were wondering why I took this zone. Don't worry, with time you will understand. So you should be taking your entry from one of these zones. And then price taps into the second one again. And then let's see what happens. Drops. And then what happens? I think this could also be the next zone to take from here to see what price does. Induce and then drop. That is basically it. And let's see what it happens after that. Comes into the traces into deeper position, grabs liquidity, then okay. Now we are having series of breakout structures to the downside. I think the price have actually shifted to the downside right now. Series of breakout structures to the downside. There was also liquidity grabs in all of them. In all of this price action, price is also grabbing liquidity. So that is just it. A case of failed swing, failed swing, failed swing. Like I think I've given two examples of it here. This one, the one I just did on GBP. Was it GBP? Sorry, I think it was Euro USD. Yes, failed swing and failed swing. So you actually expect this failed swing the highs at the highs or lowest lows of market structure. Like, of course, for a trend to switch in direction, it has to fail. The trend has to fail, and then that high becomes strong. It needs to be protected, just like this one is now a protected high until it's taken out. I don't really know if it was. I don't really know, but I don't think it was because price is already making series of. Now we have this switch. This switch I was talking about, price have now taken the switch. But then also remember that price have grabbed enough liquidity as it needed, and that's why we have this strong trend to the upside. There's every likelihood that price will not even come back into the premium and then it will continue down. I don't really know. I wasn't there. And that is just it. That is just it. It's a broken structure to the downside again. Come back into premium, grab liquidity, and then this one is grabbing liquidity. It's still going down. It's just that simple. Just that simple. Everything, grab liquidity. This one, broken structure, come back, grab liquidity, dropped, grab liquidity, dropped, broke structure, and then it's the same thing. Same thing is happening. This might also do the same thing, or maybe switch. That it came back. Was there a liquidity grab? Maybe this high. Don't really know. Or this turtle soup movement right here. Before this break of structure to the downside. It's just that simple. Price will continue to do it unless there is a switch in market structure. Unless there is a shift in market structure. Until then, until then, you just have to continue to watch price in the direction it is going. For now, I think we might have a shift. This actually looks like Wyckoff. The Wyckoff accumulation, which is not something I'm diving into right now. I'm already tired. As you can see, this is 8 minutes to 12 a.m. and I'm still making videos. I've been on my chat, my laptop since morning. I was back testing that that indice strategy, and then I discovered all those stuffs that as I presented them to the group this morning, sorry, this evening, and then it's still the same thing right here. So this wasn't even a switch. As I've still continued to the upside. So why price just came back and grabbed all these liquidities? Why? Let's just check. Okay, this was the market structure first. Okay, this is self-explanatory. When price came down first and broke this structure, the last low didn't really retrace deep into the discount. And that's why this movement had to happen. Price needs to come and rebalance everything that happened. It's that simple. It needs to like retrace deeper into the discount area. I think there's these golden zones that most traders use 70 and 70, 70.5 and 75 points. I think I have it set, but I don't really know. 70.5 and yeah, 70.5 and 78.6%. So that is the golden trade, the golden zone in Fibonacci setting. So that should be it. The next class tomorrow will now be on the market maker sell and buy models. Like what you need to look for in market before you start picking your zones. The AMD, the market maker sell series or market maker buy series and all those stuffs. Then the classic demand and supply. I think all of them will come into the class tomorrow. And then I will drop the video as well. And then after that, if there are still more videos to be made, I will complete them next week before I start taking one-on-one class. So for now, thank you. Go and back test what I've just said and see how it works in the market. Goodbye and God bless you.